Hi, my name is Elliot Gu, and I'm co-founder and chief market strategist for Energy and Income Advisor, which is one of the largest energy-focused investment research services here in the US. Now, I created this presentation today because lately I've been getting a ton of questions about natural gas prices. After all, if you're even a casual observer of the US natural gas market, you've probably seen some version of this chart over just the past few weeks. Now, benchmark front-month U.S. natural gas futures prices, traded on NYMEX, have tumbled from an intraday high near $10 a million BTUs last August, that's August 2022, to recent lows under $2 a million BTUs. Now, that's a decline of around 80% in just over 7 months, and more than 55% just year-to-date here in 2023, measured to the recent lows. For investors, the recent dips under $2 a million BTUs naturally evoke unpleasant memories of a decade of generally depressed natural gas prices that lasted from about 2011 to 2021, and superficially similar crashes for the commodity in 2016 and again in 2020. Fortunately, as with so many charts referenced in the financial media these days, front-month natural gas prices just don't provide the whole story for this market. Now, this chart shows the natural gas futures market curves, and I'll explain what that means in just a moment, on two different dates, March 31st of 2020 and March 29th of 2023. So these are about 3 years apart. Now, I chose March 29th of this year because it was the NYMEX natural gas April 2023 contract's last day of trading, and the contract settled at a price of around $1.99 a million BTUs, below the key psychological threshold of $2. However, look at the orange line representing the futures curve at the end of last month, is end of March 2023. Even at the low tide mark for gas this spring, when the April 2023 contract settled below 2, the price of natural gas for delivery in future months was much higher. Now, specifically, the price of natural gas for delivery in May 2023 was around $2.17 a million BTUs at the end of March. And gas for delivery in December 2023 was $3.68 a million BTUs. That's a full 85% above the April 2023 contract. Now, this chart shows prices for natural gas futures contracts for delivery through the end of 2027. Now, as you can see, gas futures prices are expected to remain relatively low for a few more months here, recovering to a range of $3 to $4 a million BTUs next year in 2024, and then $4 to $5 a million BTUs from 2025 through 2027. This is a gas futures curve on March 31st, 2020. That's the other line on this chart, the last time front-month gas prices were under $2 a million BTUs. Now, as you might recall, this was the height of the COVID lockdown panic when commodity prices were getting crushed and oil briefly saw negative pricing. As you can see, this curve looks very different. The shape of the curve 3 years ago is very different from today. While the front month of the curve was depressed, just like today, and under $2 a million BTUs, much like as we saw in March of this year, futures didn't reflect much, if any, recovery for years in the future back then. Indeed, as of the end of March 2020, the average price of gas for delivery between January 2021 and December 2027 was just $2.47 a million BTUs. So my point is that right now, the front-month natural gas futures contract is for May, and it's trading around $2.23 a million BTUs. But this contract's last day of trading is Wednesday, April 26. So the only thing that can influence the price of the May 2023 contract is something that can meaningfully change supply and demand conditions over just the next few days. Now, the next contract out, which has more open interest in it right now, is for June 2023. And it's trading at more like $2.40. Now, this contract's last day of trading is May 26, so a little over a month from now. So the only factors that can move it are supply and demand fundamentals over that next month or so. So if you're trading gas futures, this is all very important. It's all that matters. However, let me let you in on a little secret. This is almost entirely irrelevant if you're a natural gas producer or an investor who buys stocks in exploration production companies. After all, if you're a company that produces natural gas, you aren't going to sell all your annual production at the April price of $2.23, and you're not going to sell all your production at the May price of $2.40 either. The price of gas for delivery in December of this year, which is currently at $3.64, is every bit as important to your 2023 cash flow as the price of gas right now in the spot market or in the front month futures. In fact, many of our favorite gas producers use the swaps or the options market to lock in much of their current production many months ago when gas prices were much, much higher than today. So that's further reducing the importance of near-term spot and futures pricing on their actual financial results. Let me give you an example. Our top recommendation among natural gas-focused E&Ps right now, that's exploration production companies, has already hedged roughly 55 to 60% of its entire natural gas production expected through the middle of this year, with a floor price of about $3 for Q1 2023 production and $3.44 for Q2 production. In fact, management has estimated these hedges would generate $92 million in cash settlement from Q1 2023, should gas average about $2.50, and $165 million in cash settlement at a similar $2.50 price in Q2 2023. And that takes us through the end of June this year. The firm has also hedged more than 55% of output for both Q3 and Q4 of 2023, with a floor that's even higher, and that floor is around 350 to 360 million BTUs. And in Q1 of next year, the first quarter of next year, the hedge coverage is still 45% of expected production at a floor price of $3.61. And more than a third of production in Q2 of next year, that's second quarter of 2024, at a floor price of $3.84. So do you see how these hedges, taken back when gas prices were much, much higher last year, have sheltered this producer from near-term depressed gas prices? That's protecting free cash flow and allowing the company to continue paying a generous dividend with a yield likely to be north of 6% this year, with significant upside to a double-digit yield in 2024 if gas prices recover as we expect and as the futures market curve currently reflects. And take a look at this table. Now, I don't want to go too deep in the weeds in discussing company-specific financials in this short presentation. However, this table presents some of the main costs faced by this particular gas producer for 2023 based on the guidance management provided earlier this year, back in end of February. Production expenses includes items like lease operating expenses, or LOE, which are the costs a producer incurs to maintain production from wells it has already drilled and put into production, mainly. Gathering, processing, and transportation expenses include the cost of removing natural gas liquids, which would include hydrocarbons like ethane, propane, and butane that naturally occur in the gas stream, in the natural gas stream that comes out of a well. And these things are usually, these NGLs or natural gas liquids are normally sold separately at higher prices than gas. And this cost would also include the cost of moving gas via pipelines to market. And you can also see the big expense here, which is CapEx, which is capital spending. And for this company, that's primarily the estimated 2023 cost of drilling and fracturing new natural gas wells. Now, I've expressed all of these costs not in absolute terms in millions of dollars, but in dollars per 1,000 cubic feet of natural gas produced this year. So 1,000 cubic feet, roughly equivalent to 1 million BTUs. So it's directly comparable to those futures market prices I mentioned. And this gives us a rough free cash flow break-even price for this company in terms of natural gas prices. Now, as you can see, this company will generate positive free cash flow as long as they're fully hedged and realized price of natural gas is north of about $2.95. Now, while gas prices are below that level right now, I just showed you how this firm has already hedged a lot, absolutely the majority of their 2023 production at much higher prices of $3.50 plus, which means that even in the current depressed natural gas market, this company can generate significant free cash flow this year. On top of this, while this company is primarily a natural gas producer, it also produces significant crude oil from its wells. Now this year it's expecting as much as 21,000 barrels of oil per day, again, this year alone. It also produces those natural gas liquids I mentioned, like ethane, propane, and butane, and it expects around 13,000 barrels per day in 2023. And typically this company sells the oil that it produces at actually a slight premium to the price of West Texas Intermediate, WTI crude oil. And it sells those NGLs I mentioned, 13,000 barrels a day, at about 35 to 40% of the price of WTI per barrel. So this is very valuable sort of ancillary production that I have not included in my heavily simplified cash flow break-even cost table I just showed you. In our service, Energy and Income Advisor, I do include these additional production costs, but to simplify matters, I did not include them in the table I showed you just a minute ago. Now, if we do include all these oil-like products, that's oil itself and natural gas liquids, to this company's cash flow model, it significantly reduces the natural gas price needed to produce significant free cash flow, especially with oil so high as it is today, up around 80 bucks a barrel. All told, this stock is too cheap because far too many people are focused on depressed front month gas prices while without recognizing and pretty much ignoring the free cash flow generation capacity of this company due to its low production costs and savvy hedging policy. That presents a compelling opportunity to buy this gas producer on the cheap at attractive prices while benefiting from serious upside as gas prices and quarterly dividends, which are variable based on free cash flow, surge into the second half of this year. Now at this point, you might be wondering why I haven't mentioned the name and ticker symbol of this gas producer, and that's a very good question. But the reason is that since it's one of our top picks right now in Energy and Income Advisor for existing members, it's normally only something we reveal to paid in full members of the service. However, right now I am offering risk-free trial memberships to my Energy and Income Advisor service. You can take me up on this offer right now by clicking the link adjacent to this video. Now, if you don't like the service and you don't believe it's worth every dime of the annual subscription price, you can cancel for a full refund with absolutely no questions asked and no hard feelings within our risk-free trial period. And if you're wondering about crude oil and the potential for oil-focused producers, we do also see opportunities there. In fact, late last week, we released our latest issue of Energy and Income Advisor, which includes a deep dive look at 5 of our top oil producer picks to buy right now. To give you a bit of a taste or a preview, we suggest focusing on 2 broad themes. First, the highest quality producers with the best acreage and the lowest production costs. Now, most of our favorites in this category can actually generate free cash flow this year, even if oil were to drop below 40 bucks a barrel, which in our opinion is highly, highly unlikely. The second theme we like to focus on right now is solid oil producers with reasonable production costs, maybe not the lowest in the industry, but still well below the current price of oil. But we're looking for specific bullish catalysts. Now, by that I mean company-specific assets, sort of hidden assets or growth drivers that we believe aren't fully appreciated by the market as a whole. And there are a lot of oil producers with these sort of hidden assets to keep an eye on. For example, one of our recent picks actually has a stake in one of the most impressive and lowest cost oil projects in the world today. Now, this is a project that's profitable even with oil around $25 a barrel. But it's only just now turning free cash flow positive. Over the last few years, this company has been investing a lot of money to bring these barrels online. But with production starting up over the last year or so and really ramping up, we see a huge surge in cash flow starting this year that's just not fully appreciated by the market. Another pick we like right now has a unique liquefied natural gas or LNG project. Now that's a process for cryogenically freezing basically natural gas to turn it from gas state to a liquid form so it can be loaded on tanker ships and shipped anywhere in the world. And this is a very fast growing market. Now this particular LNG project is about to see as much as a tripling in cash flows starting at the end of this year, so starting into early next year, due to the expiration of an unfavorable contract involving gas produced from this project that contract was pricing it at a discounted price, much lower than what they're going to be able to get starting next year. Now listen, that's all I can say here, but click the button adjacent to this video and start your risk-free trial to Energy and Income Advisor today, and you'll gain immediate access to these and all of our other energy recommendations immediately. Hope you found that useful. Thanks for listening, and I hope to greet many of you as new members of the Energy and Income Advisor service on a trial basis over just the next few minutes. Thanks again.